Picture this. You finally hit that major milestone. You open your banking app and see $10,000 sitting proudly in your savings account. You feel disciplined, responsible, and financially mature. But then you look closer at the interest rate. If your account is earning a typical 0.5%, that $10,000 is generating exactly $50 after an entire year. Let's look at this chart to see how that math plays out over a longer timeline. If you leave that $10,000 in a standard account earning 1%, after 20 years, you have about $12,200. But if you put that same money into the stock market, which has historically returned around 10% annually, that same starting amount grows to roughly $67,000. The reason most people miss out on that massive growth isn't a lack of math skills, it's psychology. A savings account feels secure because the balance never drops on a random Tuesday. Investing feels terrifying because the market actually moves up and down, and that emotional volatility scares people away. Saving money is a precise tool to protect your cash, but it cannot build wealth. To actually grow your money, you have to cross the gap from saving to investing. And you can do it without risking your security by following a strict step-by-step path. Step 1 is building a true emergency fund. Before a single dollar goes into the market, calculate 3 to 6 months of your core living expenses and park that exact amount in cash. The entire purpose of this cash reserve is protection. If you lose a job, face a sudden medical bill, or need a major car repair, you pay for it with this fund. This guarantees you are never forced to pull money out of your investments at a loss to cover a crisis. Step 2 is applying a psychological strategy. You need to mentally divide your finances into 2 distinct buckets: safety money and growth money. Your safety money is your emergency fund. Its value is locked in cash, always accessible, and maintains a stable baseline that never drops. It doesn't earn much, but that is entirely fine, because its job is security. Your growth money is your investment portfolio. You must expect the value of this bucket to fluctuate. Bouncing up and down in the short term is the mandatory toll you pay for the money to expand over the long term. Establishing this firm mental wall between your cash and your investments is crucial. It isolates your daily living expenses from market volatility, which eliminates the anxiety that causes new investors to panic sell. Step 3 is actually entering the market, and you should start small. You do not need thousands of dollars to begin. $50 to $100 is plenty to open a brokerage account and make your first deposit. The goal of this initial step isn't to generate massive profits. The goal is simply to build the physical habit of moving money into an investment account. Step 4 requires focusing on simple investments. Many beginners stumble by jumping straight into day trading, options, or complex crypto speculation. These are high-risk strategies that carry high failure rates. Instead, you want a simple, highly diversified vehicle like an index fund. Rather than trying to pick one winning company, an index fund allows you to invest in hundreds of companies at once, tracking the performance of the entire stock market. This is exactly why Warren Buffett, one of history's greatest investors, has repeatedly recommended low-cost index funds as the best strategy for most people. Choosing a boring, highly diversified fund instead of gambling on individual stocks is the most reliable way to survive in the market and steadily grow your wealth over time. Step 5 is automating your investments. You set up a system to contribute money every single month, regardless of what the news headlines say or what the market is doing. This chart shows how that consistency pays off. Let's say you invest $300 every month into the market, and it averages an 8% return over 25 years. Over that entire quarter century, the actual out-of-pocket cash you contributed totals $90,000, but your final portfolio value sits at roughly $285,000. Almost $195,000 of that total comes entirely from the mathematical power of compounding. Understanding this math helps reframe the fear of market crashes. When the market drops, your automated monthly $300 simply buys more shares at a discounted price, setting you up for stronger returns when the market recovers. By staying consistent over decades, you take the intimidating volatility of the stock market and turn it into the primary engine of your wealth creation. Once you follow this path, your money works efficiently. Your savings account gives you absolute stability in the present, while your investments actively buy your freedom for the future. Relying strictly on a savings account is like keeping seeds in a glass jar. You protect them, but nothing grows. Investing is taking those seeds and planting them in the dirt. It looks messy at first, and it requires patience, but putting them in the soil is the only physical way to force them to grow into something larger. Time is the true secret ingredient to making this work. Are you currently in the saving stage, or have you already begun planting those seeds by investing? Let me know down in the comments.